Good afternoon, everybody, and welcome to our webinar on the new IFRS 15 or AASB 15 entitled Revenue from Contracts with Customers. So this is our very first financial reporting and accounting webinar for 2016, and we'll be doing once a month till the end of the year. So welcome to the Pitcher Partners webinar. So the roadmap for this session, first of all, we'll be looking at a bit of an introduction and background information around the new IFRS 15, and in Australia it is AASB 15. Then in section 2, we'll look at an overview of the 5-step model for revenue recognition, which is introduced by this new standard. In number 3 or section 3, we'll look at some potential key impacts, and we'll end off with a to-do list. So for our clients, after this webinar, what should you be doing at this stage? So let's start the webinar with our normal quiz question. Now today, it's a tennis question. It's Australian Open at the moment. I'm still recovering from last night's loss. My favorite, Roger Federer, lost in the semi-final, and it's taken me a long time to recover. But question, so what country is Angelique Kerber from, and what is she seeded at the Australian Open this year? You will know that Angelique is playing in the women's final tomorrow against the wonderful Serena Williams. So do you know what country she's from and what number she was seeded for? In the question box, if you can let me know. Oh, there's a few people who love the tennis like I do. I'm still waiting for, I don't know, maybe it's him. I know I've got the quiz master here as well, Stephen. He always has all the answers, so let's see. So the answer, she's from Germany, and she's seeded number 7, and she's done a lot better than that. She's actually playing in the final tomorrow against Serena. All right, let's go back to the accounting. Let's look at introduction and background information. First of all, why is revenue recognition important? I mean, there's a new accounting standard, so everybody's talking about a new accounting standard. How would it affect their business? How would it affect revenue recognition? But, in general, why a fuss with revenue recognition? Now, first of all, revenue is one of the most important financial reporting metrics that we find in the financial statements. It's a key number. Often it's the largest item in the statement of comprehensive income. The very first line item in the statement of comprehensive income, the largest item. Revenue, for example, sales revenue or service revenue, has a direct impact on profit. So if you don't grow the top line, the revenue line, it's really hard to grow the profit line. And we know entities want to make a profit. The other thing about revenue, it's an indication of the activity level and also the capacity of an entity. As I said earlier, it's that very first row in the statement of comprehensive income, the top line. And very important, investors often focus on revenue growth, on revenue acceleration when they look at an entity. So are they making money? Do they have a steady revenue? Is revenue growing? And based on that, they make assumptions about the organization and activities. So revenue is a really important number. And therefore, as soon as we've got a new accounting standard that would potentially impact how and when we recognize revenue, it is a big deal. It would be nice if I can get the slide to move. Let's try that. So if we continue, why is revenue recognition important? I've got a little stop sign, which is very important in my life at the moment because I'm in the process of teaching my 17-year-old to drive. And therefore, I'm really looking out for stop signs. And I really need a car with a brake pedal on my side as well. But anyway, stop sign when we talk about revenue recognition. Where is it? Important that the auditing standard ASA 240, paragraph 26 states that revenue recognition is to be presumed a fraud risk by the auditor. So even auditors place a high emphasis on revenue and revenue recognition. It's the only area in the financial statements that is a presumed fraud risk. Without thinking about anything else, before we look at the rest of financial statements, auditors would say we focus on revenue recognition. And that's not because the individual auditor makes that assessment, the auditing standards stipulate that. So revenue recognition is a big deal for an accountant, but also for an auditor. Before we go any further, I thought we should touch on the difference here between for-profit and not-for-profit entities. And first of all, if we look at for-profit entities, now the new AASB 15 will apply to for-profit entities, and then AASB 120 will continue to apply to for-profit entities, and AASB 120 is looking at government grants and government assistance. However, when we look at not-for-profit entities, at the moment in Australia, and this is Australia specific, at the moment in Australia we've got AASB 1004 contributions. We know that AASB 120 government grants, government assistance is not applicable to not-for-profit entities, it's only for for-profits. And then there's this question, so what about AASB 15? Will that also apply to not-for-profit entities, and when will it apply and how will it apply? Will it replace the current AASB 1004? And all of that, or the AASB's thinking, is outlined in ED 260, which was issued last year, which is entitled Income of Not-for-Profit Entities. Now, in today's webinar, I'm focusing on AASB 15, and I'm really focusing on explaining that for for-profit entities. However, last year, I've written an article for Chartered Accountants Perspectives article, revenue recognition, what does the future hold for not-for-profit entities? And if I can find it, and I hope I can find it easily, here you can see the article, or you're supposed to see the article. My technology today is definitely dropping me. I prepare it all and I'm sure I've got it, and now it's gone. It's missing in action. Let's try again. Where is it? No, not there. Anyway, let's go back. So when we look at not-for-profit entities, last year, if you go on the Chartered Accountants website, they've got articles written by technical people every month. And there's an article last year on revenue recognition, what does the future hold for not-for-profit entities, where the article outlines the proposals in ED 260. So if you're a not-for-profit, that's something to have a look at. If we look at the current Australian accounting standards, now at the moment there's a huge number of standards, interpretations dealing with revenue somehow or another. AASB 118 revenue, we've got 111 on construction contracts, there's interpretations on customer loyalty programs or frequent flyer points, etc. So all of these current Australian accounting standards are replaced by the new AASB 15. So if you look at the current Australian accounting standards, the framework starts with income in paragraph 70A, and then says income consists of revenue, and revenue as defined in AASB 118, which is the base standard for revenue recognition, and other income. And if you look at AASB 118, AASB 118 split revenue recognition between sale of goods, rendering of services, and interest, royalties and dividends, and has specific rules for each one of those. AASB 118 refers to revenue recognition from the ordinary activities of an entity. It's a risk and rewards model. So you recognize revenue from the sale of goods once all the risk and rewards associated with those goods have passed to the buyer, as an example. So these are the current Australian standards that we're dealing with. So what is the new standard? The new standard is AASB 15. The title is Revenue from Contracts with Customers. It replaces the existing revenue recognition guidance in US GAAP and IFRS. It replaces all those current Australian accounting standards. An interesting fact, if you look at the number of pages that we've got in the existing IFRSs that deal with revenue recognition, so that is, AASB 118, all the interpretations, everything, we've got 77 pages. However, if you look at the number of pages in this new IFRS 15, we're talking about 341 pages. So I wouldn't call this a simplification or a shortening project, but a way to put all the accounting standards and all the revenue recognition rules in one place, IFRS 15 or AASB 15. At least this is a success story for the International Accounting Standards Board and the US standard setter, because it replaces revenue recognition guidance in both jurisdictions. So some key facts of AASB 15 before we start. So it's a single and a comprehensive framework which sets out how much revenue we're going to recognize and when. Because revenue recognition is a timing question. When do we recognize the revenue? AASB 15 introduces a 5-step model, which is a brand new model or approach. And you use that model to determine when to recognize revenue and at what amount. There are also new qualitative and quantitative disclosure requirements, which clients and entities should be aware of, because you'll have to start to change your systems to capture the information that you would need to meet the disclosure requirements. AASB 15 provides application guidance on a number of areas, specifically warranties, licenses. So it's not just the bare bones, there's also a lot of application guidance. Effective date now, initially when AASB 15 was issued, it was for annual periods beginning on or after 1 January 2017. And then during the year, the American standard setter, the International Accounting Standards Board, and also the AASB postponed the implementation or the mandatory application date of AASB 15 to annual periods beginning on or after 1 January 2018. So in Australia, if you've got a 30 June year end, we're looking at 30 June 2019, which is just over 3 years away. Early adoption is permitted under IFRSs. So another quiz question before we look at the 5-step model. So as has recently been revealed, at what rate has Google been effectively taxed in the UK? So has anybody seen the press? What do you think? Let's look at the question section. Please pop in your answer. I would love to see what you think. Do you know at what rate? Oh, there's a few good ones. Brendan, Andrew, Cassandra, Daniel. Daniel, you the closest at the moment. Oh, Rod Shanley, you beauty. Rod Shanley, our audit partner there from Sydney, he's got it right. Simon has it right. Well done. Everybody seemed to be quite close though, so well done. So the answer is around 3%. Isn't that amazing? Anyway, if we go back to an overview of our 5-step model. The core principle is that entities would recognize revenue to depict the transfer of promised goods or services, and promised goods or services are performance obligations. So depict the transfer of promised goods or services or performance obligations to customers in an amount that reflects the consideration to which the entity expects to be entitled. An emphasis on that, expects to be entitled in exchange for those goods or services. And I'll come back to this. It's the amount that we expect to receive. And there's an emphasis in this definition on customers. So if we consider, so what does customers mean? So a customer is a party that has contracted with an entity to obtain goods or services that are an output of the entity's ordinary activities in exchange for consideration. So, important that if you look at this standard, we are focusing on customers. So there's a contract with a customer to deliver goods or services, and these goods or services are output of an entity as a result of their ordinary activities. And, for some consideration, it's not a donation. So that's a core principle. If we look at steps to apply this core principle, or to break it down into steps, the first step is that we have to identify the contracts with the customer. So if you go back to the core principle, it's talking about customers, it's talking about contracts. So first of all, identify the contract or the contracts with the customer. In step 2, now that you've got the contract or contracts, identify the separate performance obligations. So identify which goods or services have you promised to your customer. Step 3, determine the transaction price. So what do I expect to receive for these promised goods and services once I deliver them? Step 4, we allocate the transaction price. So although this whole contract could have a price attached to it of $100, that contract has been split into separate performance obligations, and therefore in the same way the transaction price in step 3 have to be allocated over those separate performance obligations. And then in step 5, we recognize revenue when a performance obligation is satisfied. So what they're saying there is it is possible that you could have a contract with a customer that has different performance obligations, and that we're going to satisfy those performance obligations at different times. And therefore we would recognize the revenue at those times. So 5 steps to apply the core principle. So let's look at each step on its own. Step number 1. So step number 1 is to identify the contracts with the customer. The first thing is a contract is an agreement between 2 or more parties, and it creates enforceable rights and obligations. And the standard specifically says that this enforceability or enforceable rights and obligations is a matter of law in a specific jurisdiction. So the standard doesn't go further and say when would these enforceable rights and obligations be created in different countries. Right? That's a matter of law in that country. But as soon as we've got this agreement and it creates enforceable rights and obligations, we have a contract for AASB 15. They say specifically, and it's similar to what they say, or the ISB and the AASB say in AASB 10, AASB 11, contracts can be written, oral, or implied by an entity's customary business practices. So usually we would like, especially auditors, would like to see a contract in written form. It could be an oral contract, and then the auditor would like to see detailed notes of that contract, or it could be implied by the customary business practices, or that's how we usually do business. So that could also be a contract. When you look at step 1, identifying the contract or contracts with the customers, there's really 2 parts to it. Is you have to identify the contract, and then you also have to consider the potential to combine contracts. So identify the contract or all the contracts, and then consider, should we combine these contracts? So really, if we look at the first part, and that is, do we have a contract or does a contract exist? There's 5 parts to it. If we start on the left-hand side of the screen, identify each party's rights. You know, a contract would exist if the contract identifies each party's rights regarding the goods or services that will be transferred. A contract would exist if payment terms can be identified. Remember, we said in the core principle there's some consideration involved here. So can we identify the payment terms? Then we've got a contract. The third thing, right in the middle, very important, the contract has been approved by the parties and the parties are committed to their obligations. So if the contract had to be approved by the board of directors, we only have a contract once the board of directors have approved the contract. Right, so it should be approved by all the parties, and the parties have to be committed to their obligations in terms of the contract, because the contract establishes rights and obligations for both parties. The fourth one, the contract has commercial substance. So, you know, it creates cash flows or changes cash flows for the parties going forward. And then the last one, the collection of the consideration is probable. And I would like to emphasize this. The collection of the consideration is probable. So before we decide that we've got a contract for the purposes of AASB 15, we have to assess whether the consideration outlined in this contract is probable. So if we just zoom in on that, the collection of the consideration is probable. So entities apply the revenue recognition model in AASB 15. If at the start of the contract it is probable that they will collect the consideration to which they expect to be entitled. So when we think, you know, is it probable that we'll receive or collect this consideration, entities have to consider the customer's ability to pay the money and also their intention. So it's really important that before we have a contract, we have to satisfy ourselves that our customer has the ability and intention to pay the consideration. And why is that? Because we do not want entities to recognize revenue and then have big impairment losses very soon or in future. So we only have a contract once we've considered and assessed that the collection of the consideration is probable. Really important. Now, a lot of clients would say to us, but we do this. We do credit checks. We don't sell to customers who haven't passed a credit check. So it's about their ability, that's a credit check side, but also their intention that they'll pay us, and we assess that. So that intention, I think, comes back to understanding terms and conditions of contracts and responsibilities, cancellations, cancellation fees, you know, the whole thing. So if remember, I said in step 1, it's identifying the contract, and there's a number of things that have to be in place before we will say, tick, we've got a contract. But then we should also consider the potential combination of contracts. So if we move on to that potential combination of contracts, the standard says that 2 or more contracts that are entered into at or near the same time and with the same customer or related parties are accounted for as if they were a single contract, provided at least one of the following criteria is met. So there's really 3 parts to it. It's same time, same customer, plus one of the following 3 things. And if you tick all of those, Same time tick, same customer tick, one of the following tick, then you can combine, or you should combine these contracts. You can see that this is quite judgmental. So what does same time mean? Same day, same month, same quarter, within 2 weeks? No idea. So same customer or related parties, who are related parties? Who would all be deemed to be the same customer? If you look at one of the following criteria, it could either be that the contracts are negotiated as a package with a single commercial objective. So a package deal, I always think, if I'm Telstra and if Pitcher Partners come and we organise mobile phones for the partners and internet access for the firm and 4G cards for the auditors who go out to client premises to audit, and all those things, if we negotiate that as a package, I think we can tick this criteria. The second possibility, the amount of consideration in one contract depends on the price or the performance in another contract. We give you a good deal on internet, but you maybe pay a little bit more on mobile phones, and it depends on usage. And if you buy enough mobile phones, or if you use enough airtime, you get a bigger discount on the internet. So there's some linkage between the different components maybe. And the third one, the goods or services that are promised in the contracts, or maybe some of the goods or services that are promised in the contracts represent a single performance obligation. So what they're trying to say is it's substance over form. And I love substance over form. So even though you have 20 different legal contracts, the accountants come and they say, lawyers, forget about your 20 contracts. We want to look at the substance. And the substance is that the goods or services that are in these 20 contracts is a single performance obligation. And the substance is a single item or a single service. All right, so you can't fool us with your 20 contracts. We look at the substance. So we will put them together if it's same time, same customer, and one of those things. So that's step one. Do we have a contract? Have we considered whether we should combine these contracts or not? When we go to step two, in step two, once we've now determined this is the contract or this is the combined set of contracts for AASB 15 purposes, step two is to identify the separate performance obligations. Now, a performance obligation is a promise to a customer to transfer a good or a service or a bundle of goods or services that is distinct, emphasis on the word it's distinct, or it could be a series of distinct goods or services that are substantially the same and that have the same pattern of transfer to the customer. So as example of a good that's distinct is we deliver a mobile phone to you. And if you think about an example of a series of distinct services, it is we continue to make airtime available to you as Pitcher Partners, where you can send text messages, you can access data downloads on your mobile phone, etc. So it's the same thing. We give you airtime or access to airtime, and we give it to you every day over the next 24 months. So that's a series of services. So the question in step two, is this good or service distinct? Yes or no? If we say the good is distinct or the service is distinct, then we've got a separate performance obligation. If we say no, it's not a distinct good or service, then you have to combine the good or the service with other promised goods or services until you've got a bundle of goods and services that is distinct, and then you account for all of that together. So the idea is to get to a distinct good or a distinct service, and if you cannot do that, a bundle of goods or a bundle of services that's distinct. Because we want to identify these separate performance obligations We want to allocate the transaction price to those separate performance obligations. And whenever we satisfy those performance obligations, we want to recognize the transaction price as revenue. So it's important to determine these distinct goods or services. So in doing that, you will start, or you should start with, can the customer benefit from the good or the service, whether it's on its own or with another readily available resource? So if you say no, then it's definitely not distinct. So let's say I've got a mobile phone. I'm Telstra and I give a customer a mobile phone. Can the customer benefit from the mobile phone, whether on its own, just the mobile phone, or with another or other readily available resources? I reckon they can. So my customer can buy the mobile phone, they can go to any service provider and buy airtime, readily available resources. So I think that mobile phone will tick the first box, towards a distinct good or service. Is the promise to transfer a good or a service separate from other promised goods or services in the contract? So if you sign a contract with a Telstra, is that promise that Telstra gives you to give you a mobile phone and to give you airtime over the next 24 months, are those separate things? So let's think about it. There's three things to consider. It would be separate if the entity does not provide a significant service of integrating the goods or services. Now you walk out with your mobile phone. Telstra don't integrate your mobile phone into your work email or anything else. You just walk out with your mobile phone. Or look at the second one. A good or service does not significantly modify or customize other goods or services. Again, it's not integrated, it doesn't need modification, it's not a software that modifies other things. Third thing, a good or service is not highly dependent or interrelated with other goods or services. Again, in that situation, I would say a mobile phone is quite separate because you could use it with other things. It's not integrated. It doesn't customize anything. And if you say yes to both of those, the good or the service is distinct. If you say no to any of those two questions, it's not distinct. So very important to consider it and go through the process. Let's think of an example where something is actually integrated and therefore should be treated together. So if you have a contract to install a machine at a client, and you also have to, you sell the machine, you have to install it, then you have to test it, and there's a whole process involved. Maybe that machine has to be integrated with the rest of the factory, so it has to be customized to work there, which is often the case with software, etc. In that situation, one would say it's integrated and it's not a distinct good or service because it's integrated with other things and other things you are doing. So let's move on to step 3. So step 1, we've identified we've got a contract, we've bundled them together or we've put them together. In step 2, we've split it out in the separate performance obligations. And now in step 3, we determine the transaction price. Now, often a transaction price is as easy as looking at an invoice and see the invoice amount. However, AASB 15 contemplates a lot of other things and say it's not always that easy. And they define a transaction price as the amount of consideration to which an entity expects to be entitled in exchange for transferring goods or services to a customer. So again, we see those words, consideration to which an entity expects to be entitled, our expectation. So to determine that transaction price, an entity has to consider a number of things. The first thing to consider is maybe there are amounts payable to the entity. It could be that, consideration payable to a customer. So not only are the customer paying you, in certain situations you have to pay something to the customers. And if we have to pay money to a customer, is that a reduction of the transaction price? Or is it a payment for a distinct good or service, or is it a combination of the two? So one have to investigate that. Also, one have to consider whether there's a financing component involved. So for contracts that have a significant financing component, entities have to adjust the promised amount of consideration to reflect the time value of money. So if I sell something to a customer and they're going to pay me $100 in 5 years' time, we cannot say that the transaction price today is the $100. It has to be the net present value of the $100. So one have to consider a financing component. Remember, the other side of it is also true. If you are constructing a building for a customer and they pay a deposit to you on day one, and you're going to build the building over the next 5 years, and let's say you'll only recognize the revenue at the end of the 5 years, just for my example, then you'll say, listen, I've received the cash today, but there's financing involved in there. My customer is actually providing financing to me. And therefore, that finance expense should be recognized as well. So it works both ways. You can provide financing to your client, or your client can provide financing to you. Doesn't matter which way you go, that would impact the transaction price. So in that situation, your invoice price doesn't equal your transaction price. If we look at non-cash consideration, non-cash consideration should be measured at fair value and be incorporated into the transaction price. And then the last one is the new aspect, and that is the variable consideration aspect. You have to consider variable consideration when you determine the transaction price, and variable consideration has a constraint attached to it. Now, examples of variable consideration could be discounts given to customers, or credits, or price concessions, returns, or performance bonuses or performance penalties, and all of those things could lead to a variable consideration. So the invoice amount is $100, but if you pay within a certain period of time or meet certain conditions, you get a discount, a credit, etc. So how do we deal with that? So variable consideration is something to really focus on. So the first question is, do we have variable consideration, or is the consideration variable? If you say no, it's easy, you just go with the transaction price. If you say yes, the consideration is variable, there could be a discount, there could be a credit. The next question is, what you have to do next is to estimate the amount using the expected value or the most likely value. Now, that's one part of it. The tricky bit is you have to determine the portion, if any, of that amount for which it is highly probable that a significant revenue reversal will not subsequently occur. So if we want to recognize revenue, we have to make sure that the variable aspect of that transaction price, it's highly probable that it will happen, because we do not want to recognize a high revenue and then there's a revenue reversal in future, or we cannot collect the money, or there's a potential impairment, etc. So there's this requirement that it has to be highly probable. So an example here, and this is an interesting one. Let's say a company sells products to a distributor, and let's say that distributor has a right of return if they cannot sell our products. So I sell products to a distributor, or I provide products to a distributor, and if they don't manage to sell it to their customers, they can return it to us. Now, in that situation, at the moment, if we look at the AASB 118 requirements, at the moment, we would only recognize the revenue from the sale of those products. when our distributor make a sale to their customers. Going forward, when you look at AASB 15, you may be able to recognize revenue from that sale a lot earlier, based on historical experience of the number of products for which it is highly probable that your distributor will sell to customers and they will not return it to us. So we don't have to wait for the distributor to sell the products to their customers before we recognize revenue. If we've got enough historical evidence, past experience, and we can make an assessment and come up with an expected value, and that is highly probable that they'll make the sale, we can recognize the revenue once we deliver the good or the service to the distributor. But it has to be highly probable. So it's not a guess game. It's not necessarily something you do in a new business or in a startup. You need experience in that situation. So this is a really good example where this variable consideration, discounts and has an impact on when we recognize revenue. The next one is steps to apply the core principle is step 4. So we've got a transaction price, we've considered discounts and whether discounts are highly probable, we've considered non-cash consideration, and now we have to allocate the transaction price to the different performance obligations, which we've established in step 2. So usually entities will allocate transaction price to each performance obligation identified in step 2. In proportion to its standalone selling price. And the best evidence of standalone selling prices is an observable price from standalone sales of that good or service to similarly situated customers. So let's say I've got 2 products together and I sell it to a customer for $100. However, if I sold it to the customer separately, I would have sold it to that customer for $80 and $40. So the customer is getting a good deal in that they get both products for the $100. It is important that we allocate the $100 between the 2 products, which are 2 separate performance obligations, and that you work out that 80 divided by 120 and multiplied with your $100 will go to the one product, and 40 divided by 120 multiplied with 100 will go to the other product. So we use the standalone selling prices to come up with relative percentages to use to allocate the transaction price. Now, if the standalone selling price is not directly observable, sometimes it's not, you could estimate it either by coming up with an adjusted market assessment approach. You can look at expected cost plus a margin, and that's what it would cost us, and what's our normal margin on top of cost. And then they say in limited circumstances, and that's not really advised, limited circumstances, you could use a residual approach. So what do they mean by that? Let's say the combined value was 100. And we know that one product has $100 for 2 products, and we know that $80 is the standalone price for one of the products. We don't know what the standalone price of the other product is. So after we've tried all these other things, in limited circumstances, we could say, 80 go to the one product and 20, the 100 less the 80, the 20, the residual approach, would go to the other performance obligation. So we shouldn't really do that. You should come up with a standalone selling price for both products. And then you allocate the $100 over those 2 products. Step 5. So we recognize revenue when a performance obligation is satisfied. So we've got different performance obligations in step 2. In step 4, we've allocated transaction prices to the different performance obligations. And now in step 5, an entity recognizes revenue when or as it satisfies a performance obligation by transferring control of a good or service to a customer. So control could be transferred at a point in time. So I give you the mobile phone now, or I give you the clothes when you walk out the store, or you drive away with your car. So at a point in time, you get control over the goods. Or it could be over time. So is it at a point in time or is it over time? That's the question. Because if it's at a point in time, that's when you recognize the revenue. If it's over time, we will recognize it over that period of time. So the question in step 5 is, does the entity transfer control over time? If we say yes, then we recognize the revenue over time, using a method that depicts its performance. So we have to establish, so how do we transfer control over time? You know, what is the best method to depict that performance? You know, is it going? Is it even, or is it a reducing balance method? If we say, does the entity transfer control over time, and you say no, then we recognize revenue at the point in time that control is transferred. So to decide whether an entity passes control at a point in time or over time, the standard says there are 3 things to consider. And they say if one or more of the following is met, then you transfer control over time. So it's really saying our starting point is we transfer control at a point in time. However, if you meet one of the following 3, you could say we transfer control over time. So the first one is the customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. So I would say that is when we use our airtime. So we receive the airtime as a customer and we consume it at the same time over the 24 months of our mobile phone contract. The second one, so you know, it's usually a type of a service. The second one, the entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. And again, we're saying then the entity transfers control over time. Now, to me, the best example of this one is the construction of a house. Now, about 8 years ago, we bought a block of land. And so we owned the land, my husband and I, we owned the land. And then 8, 9 years ago, time flies, and then we went to a company that, you know, have the architects, they design the house and they build, so they design it, they build it, everything. And we signed a contract with them. And they built our home on our block of land. So really that builder performed or, you know, that builder's activities created or enhanced an asset which I, the customer, controlled. And as they were building the house, I controlled the land, it's my block of land, and the partially completed house was also mine. So in that situation, that builder or developer would say they transfer control over time to me, because as they built the house over time, over the months, I control it. So they would recognize revenue over time. Now that is very different to if you buy a land and home package, where you buy a land and home package or an apartment in the CBD off a plan, and you put down a deposit, and then you go away, and the developer buy the land, the developer construct a building, and let's say a year later you pay the final amount, you get your keys, you get your title deed, and you move in. Now in that situation, the developer has not enhanced or created something that you, the customer, controlled. The developer built a building on property that they controlled. So they would, in that situation, the developer or the builder should recognize revenue at a point in time when they hand your apartment to you. Right? So that's a very different situation. Then in number 3, The entity's performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for performance completed to date. So if a developer is or a builder is building a factory that has no alternative use. This factory is designed for my business, for the customer's business, and we are the only people manufacturing a certain product. If I don't pay, it's not as if the builder can, sell it or lease it to anybody else. And also there has to be that enforceable right of payment. So if the builder builds half a factory and we decide we don't want him to finish it, there has to be an enforceable right that I have to pay him. In that situation, again, we'll say it's either transfer control over time and they don't have to wait to recognize revenue right at the end. So it's a big decision. And do we transfer control at a point in time, like land and home packages, or you're buying an apartment in the CBD of a plan? Or do we transfer control over a period of time? So then if you look at control, how do we know whether control passes at a point in time or over a period of time? AASB 15 has a lot of judgment involved. It's very subjective, and this is another area that illustrates that. So indicators that control has passed to a customer include that the customer has a present obligation to pay, so they owe us the money. The customer has physical possession of the asset. The customer has legal title of an asset. The risk and rewards of ownership has passed to the customer. And remember, the current AASB 118 has a risk and rewards model, but now it's only one of the things to consider in AASB 15. So these are indicators. You look at all of these, and on a balance of facts, based on facts and circumstances, you make an assessment whether control is passed or not, or the customer has accepted the asset. So very judgmental, and you have to think about this carefully. Right, before we go on, question 3. What band came first in Triple J's Hottest 100 for 2016? So Stephen Whitchurch, give me this one. He's the master of the quizzes, so I thought this one is for Stephen. Come on, Stephen. Finally, I've got a question where Stephen don't have an answer. All right, so at least I know the audit partners are not following the bands. Stephen, I had no idea. This is Bree coming up with the good questions. I just want to say, Stephen, this is for you and I to feel very old. Many people have answered this correctly. So, absolutely. Yes, and at least our audit partners have a sense of humor, because a certain audit partner from Sydney said he reckons it's not Justin Bieber and it's not the Bee Gees either. Anyway, so what band came first? A lot of you had it right, so well done. I'm suitably impressed. The Rubens, never heard of them. Never heard of them. Anyway, so if we look at key impacts in section 3, and this is, potential key impacts of this new IFRS 15 or AASB 15. For some entities, there may be little change in the timing or the amount of revenue recognition. All right. However, you cannot, as an entity, just sit back and say, oh, it doesn't impact me. It won't change the amount. It doesn't change the timing. It will require you to assess and to do quite a bit of work to form a conclusion on whether this impacts when you recognize revenue and whether it impacts the amount. Right? Because the model is completely different and it's a different way to think about revenue recognition. We'll have to do a mind shift and look at all our revenue streams and assess on the new AASB 15 what is the answer, compare it to the current answer in terms of AASB 118, and then form a conclusion. So it's really important that we have an understanding of the new model, and also we have to do an analysis of the application to particular transactions in an organization. Now, some generalizations. Now, these are big generalizations. I'm saying this up front, but things to think about. That's really what I'm saying is entities that currently use the stage of completion or the percentage of completion method to recognize the revenue will need to reassess whether they should recognize revenue over a period of time or at a point in time in future. So if you currently use percentage of completion method, you need to make that assessment. And if you decide that you will still recognize revenue over time, the manner in which you progress towards completion and how you measure that might change. So that is something to think about. Now, revenue recognition could be accelerated or deferred. You know, it could be that with the example I've used earlier where you use a distributor, because you've got historical facts, past experience, revenue recognition is accelerated or brought forward. Or it could be the other way around, maybe for a property developer. The other thing is we'll have to look at the timing of tax payments, the ability to pay dividends in some jurisdictions, covenant, loan covenant compliance could be affected. Also incentive plans and how you remunerate your staff bonuses and incentives, and make sure that it's still aligned with corporate goals. Your sales and contracting processes may need to be reconsidered. You might want to reconsider your current contract terms, your business practices, if you want to achieve or maintain a particular revenue profile. You might have to update your IT systems to capture additional data. And maybe you need additional data to build a case that you've got enough historical evidence to say that variable consideration is highly probable. So you'll have to capture that data and start with that as soon as possible. A number of new estimates and judgments will be required. So it's a grey standard. You have to make estimates, you have to apply judgment, and therefore important that we come up with processes on how to come up, how to make estimates, how to make judgments, how do we revise it, etc. Obviously, accounting processes and internal controls will have to be revised. Because entities will have to ensure that completeness and accuracy of the information, specifically if it's information that we'll collect now that we haven't collected in the past. There's a lot of new disclosures required, qualitative and quantitative, and as you know, disclosures can be time consuming, and there's a lot of additional effort to capture that information. Please note that there are no exceptions for commercially sensitive information. So if AASB 15 requires certain disclosures around revenue, you have to make the disclosure. You cannot say it's commercially sensitive. There's no exception there. And then also entities will need to communicate with stakeholders, shareholders, investors, how the new revenue recognition standard will impact revenue recognition going forward. So it's only for 30 June 2019 in Australia. But as you know, ASIC is focusing on this, and AASB 108 requires us to disclose the potential impact of new accounting standards that's been issued but not yet effective. So definitely we have to think about that and disclose that to our stakeholders. So who will be most impacted? Again, it's a huge generalization, but entities that sell products and services in a bundle, because you'll have to come up with separate performance obligations. If you're involved in major projects, telecom, software, engineering, construction, real estate, and we've got a lot of clients in that space, you'll be impacted. And it could significantly change the timing of revenue recognition. Whether it's bringing it forward or pushing it out, there could be big changes. All entities should consider whether they require changes to systems and processes to collect data. Even if we don't expect the answer ultimately to change, at least we have to build up a case to prove that to the auditor. And remember, there's extensive new disclosure requirements that we have to cater for. So a to-do list. I think it's really important that our clients and all entities identify all the revenue streams of the entity and obtain a detailed understanding of each revenue stream. So we should already know what all our revenue streams are and a detailed understanding of it. And then we should say, determine when and at what amount revenue is currently recognized for each revenue stream. So we, at the moment, complying with the existing Australian accounting standards, and let's make sure that we've got it right. So we have the revenue streams, we know how it works, this is the revenue recognition. That's the starting point. Then we have to identify and evaluate our current revenue recognition accounting policy. So this is all current situation. Then we go on. So that's a baseline. Go on. Consider when and at what amount revenue would be recognized when we introduce the new AASB 15. So how do we think revenue recognition, the amount and the timing would change? If we're not happy with that, it's years, 2-3 years before AASB 15 becomes mandatory. So potentially we could look at the way we do business and our contract terms and our revenue recognition policies and see if we want to change it to get to the desired outcome in terms of AASB 15. And then I think and to me, that's the key thing. It's not to wait for AASB 15 to become mandatory and then realize we're not happy with the outcome. It's to think about it in advance and plan for it. And if you are allowed to change it, contracts, you change it. It's not always possible, but if you can, at least do some planning well in advance. So what did we do today? I've given you a quick introduction and a bit of background around AASB 15. We looked at the overview of the 5-step model. We've looked a little bit at practical application or potential key impacts. We looked at a to-do list. Right at the end of the webinar, I just want to flag a few things. First of all, please join us for our monthly financial reporting and accounting webinars. And how do you do that? You can email me and I'll add your name to a distribution list. Or a very easy way is link with me on LinkedIn, because I put all the invitations every month and the registration login details on LinkedIn. So you can use LinkedIn as a very easy way to do it. Also, if you want to subscribe to our monthly financial reporting and accounting newsletters, please contact me. Again, I also put it on LinkedIn. It also goes on the Pitcher Partners LinkedIn account. The other thing is recorded webinars are also available on YouTube. So if you go on YouTube and you just search for AASB 15, you'll see it will come up, and I'll show it to you very shortly. And the other thing, if you're looking for newsletters or old newsletters, you can go search on the internet, Pitcher Partners and a standard number, or you can look on the web, on our Pitcher Partners website, and I've given you the address there. I'll try and show, I've tried to open a few of these for you and see if I can show it to you. Let me just try and show you this one. This specific one is a newsletter. There you can see on the Pitcher Partners website. Last year in July, there was a newsletter on AASB 15, which we've done today. There are some pretty pictures, some diagrams, some decision trees, and some of these decision trees were too big to incorporate in the PowerPoint slides, so you can go and look at that. Quite a few number of PowerPoint decision trees. So if you go to the Pitcher Partners website, you can see our newsletters. The other thing, if you go to YouTube, I went to YouTube and I've put in AASB 10, just that, AASB 10, and there you've got the Pitcher Partners YouTube webinar is the first thing you see. If you go down, there's also one on AASB 3, there's one on AASB 13, there's one on AASB 11, so all there. If you want to look at recorded webinars, within a few days we put it on YouTube. We also send a link of the recording to you. Then LinkedIn, if you've got a LinkedIn profile, there you've got my profile. You can see I've put there invitation to all the webinars. Yesterday we've put up a new newsletter on the new IFRS 16 leases, all the invitations, registration details. So if you connect with me, you'll also have access to it. It's an easy way to do it. So if we go back to our presentation, thank you very much for joining me today, just over an hour. If you've got any questions, especially if you've got answers, please contact me. Thank you very much for joining me. There's my email address if you'd like to contact me. And I'll see you next month. Next month we talk about the new IFRS 16 on leases and the end of the road for operating leases. So speak soon. Thank you very much.